Look at the number on your screen right now and do not look away until the gravity of what you are seeing finally sinks in. $79.11. We are sitting mere pennies away from an $80 silver reality. And yet the world continues to move as if the foundations of the global financial system are currently being incinerated. We closed the session just a breath away from the all-time high of $79.57. And I want you to stop and think about the sheer speed of this transition. Think back to 48 hours ago. Think back to Christmas Day. While the rest of the world was distracted by holiday traditions and family dinners, while millions sat around their tables completely unaware of the financial earthquake building beneath their feet, I sat in front of this camera and warned you about the arrival of Ghost Week. I told you that the period between Christmas and New Year's creates a liquidity vacuum, where price discovery no longer happens in measured steps, but in violent vertical leaps. I told you that the banks were asleep at the wheel, that the skeleton crews manning the trading desks would be powerless to stop what was coming, and that the volatility would be nothing short of predatory. I warned you that thin markets are dangerous markets, that they amplify every movement, and that a handful of strategic buyers could move mountains when there's nobody standing on the other side of the trade. Tonight, the data has vindicated that warning in the most explosive way possible. We didn't just drift higher on light volume. We didn't gently climb another rung on the ladder. We detonated. We ripped from $71 through every psychological resistance level that the bullion banks spent decades building, 75, 76, 77, 78, and we didn't stop until we kissed the sun. In a single trading session, we witnessed an $8 candle that would normally take weeks or even months to materialize in a normal market environment. To anyone still sitting on the sidelines, to anyone still calling this a bubble or a speculative fluke, to anyone dismissing this move as temporary insanity, you are willfully ignoring the most significant structural shift in the history of capital markets. We are watching a market that has snapped its chains. This is no longer a theory or a forecast or a projection based on hopeful thinking. It is a blue sky breakout happening in real time, unfolding before your eyes with the unstoppable momentum of an avalanche. When an asset breaches its all-time high, as we did at $75, something fundamental changes in the psychology and mechanics of the market. The overhead supply vanishes completely. There are no more trapped investors waiting to sell at their break-even price, no more bag holders desperate to exit their positions at any level that allows them to escape with dignity intact. Every single holder of physical silver on the planet is now in profit. And when everyone is in profit and the underlying physical supply is non-existent, when there are no sellers left and only buyers remain, the price does not climb stairs. It takes a rocket ship. We are up 6% in a single day and nearly 170% year to date. Let that number settle in your mind, 170%. Silver is currently the single best performing asset class on the face of the earth, outclassing Bitcoin, which dominated the headlines for years, outperforming Nvidia, which everyone celebrated as the AI darling of Wall Street, and leaving the S&P 500 in the dust like a forgotten relic of a bygone era. Nothing comes close. Nothing in traditional equities, nothing in crypto, nothing in bonds or real estate has delivered returns even remotely comparable to what silver has achieved in the past 12 months. Yet, if you turn on the corporate news, what do you hear? Silence. Deafening, deliberate silence. They are talking about retail sales figures and holiday travel delays and the latest celebrity scandal, while the tectonic plates of the monetary system are shifting forever beneath their very studios. This silence is not an accident. It is not an oversight or coincidence. It is your greatest strategic advantage. The fact that the general public is still completely oblivious to $80 silver, that your neighbor has no idea this is happening, that the average investor is still chasing tech stocks and meme coins, means we are nowhere near the peak of this mania. We are currently ending the stealth phase and moving into the institutional panic phase. You can hide a 50-cent move in the back pages of the financial section, but you cannot hide a chart that is going vertical. You cannot suppress a story when the numbers become too big to ignore. The giants are waking up, and the reason they are waking up is far more terrifying than simple price action. It's not about greed or FOMO or catching the next hot trade. The trigger was pulled this morning. A high-frequency signal flashed on institutional dashboards across the world that hasn't been seen with this level of intensity since the banking crisis of 2011. This is the emergency siren that wakes up the world's largest pools of capital. The pension funds managing the retirements of millions of teachers and firefighters, the sovereign wealth funds controlling the treasuries of entire nations, and the university endowments that have been sleeping peacefully for decades. These entities do not trade on headlines or social media trends or the latest YouTube video. They are bound by strict mathematical mandates and asset allocation charters written in legal stone. Today, the gold to silver ratio did the unthinkable. It crashed below 60. For those who don't understand the significance of this number, let me explain why this is an earthquake-level event. For nearly a decade, the bankers forced this ratio to hover between 80 and 100 through relentless paper manipulation. tricking the world into believing silver was nothing more than an industrial byproduct of zinc and copper mining, a mere commodity with no monetary relevance whatsoever. They made you believe silver was just another base metal, something to be used and discarded, not something to be treasured and accumulated. But when that ratio compresses below 60, when silver begins closing the gap with gold at an accelerating pace, it triggers a mandatory rebalancing signal for trillions of dollars in institutional capital. With gold trading at $4,500 and silver hitting 79, the ratio has collapsed to 57.3. To an institutional fund manager sitting in an office in New York or London or Singapore, this is not just interesting data. This is a screaming, once-in-a-career arbitrage opportunity that their models are telling them they cannot ignore. These funds are legally required to hold precious metals as a hedge against inflation and geopolitical instability. But they are also required by fiduciary duty to seek the best value for their beneficiaries. Their sophisticated algorithms, running on supercomputers worth millions of dollars, are now screaming at them that silver is critically undervalued relative to gold. The historical average ratio is closer to 50 or even lower, and when you can buy an asset that is mathematically underpriced by 20 or 30% compared to its sister metal, the decision becomes automatic. What you saw today wasn't retail FOMO from small investors clicking buy buttons on their phones. It was the front running of a massive institutional rotation that is about to reshape the entire market structure. The smart money, the insiders, who get the phone calls before the official announcements, knows that on Monday morning, and especially on January the 2nd, when the full investment committees return from their holidays and reconvene their quarterly strategy sessions, the buy orders will be automated. The computers will execute without emotion and without hesitation. If a pension fund has $10 billion in gold and zero in silver, and their rebalancing model tells them to capture this ratio compression by diversifying into the white metal, they will move $500 million in a single blink, in a single keystroke, without a second thought. In the gold market, $500 million is a ripple in the ocean, barely noticed by the larger ecosystem of deep liquidity. In the silver market, $500 million is a tsunami that washes away the entire order book and leaves nothing but chaos in its wake. The silver market is small, dangerously small, and it cannot absorb this kind of capital inflow without experiencing price discovery that looks more like a heart attack than a gentle upward trend. Now, imagine 10 of these funds acting simultaneously, all receiving the same signal from their risk management systems at the same moment. Imagine a sovereign wealth fund from the Middle East or Norway, sitting on hundreds of billions in oil revenue, deciding to allocate just 1% of their treasury to physical silver as a strategic reserve asset. We are talking about a $50 billion wall of capital that is programmed to enter this market regardless of the price, regardless of what happens next week or next month. These buyers are price inelastic. They don't care if silver is at 79 or 85 or 90. They have a mandate to fill a box to check an allocation target to hit, and they will sweep the book until their orders are complete, buying everything in sight until their algorithms tell them they've reached the required position size. This is why $80 feels like a magnet pulling the price upward with invisible force. The traders who are awake right now, who understand what's coming, are scrambling to accumulate every ounce of inventory they can find, because they know with absolute certainty that they can sell it back to these pension funds next week at $90 or $100. They are front-running the inevitable. They are positioning themselves between the source and the destination, ready to profit from the coming collision. But this creates a minefield for the coming week, a powder keg waiting for a spark. I have titled this warning Danger Next Week for a very specific reason, not to create fear, but to prepare you for what's about to unfold. When you have a market that has moved this far, this fast, when you've compressed months of normal price action into a handful of trading days, and you introduce a massive class of institutional buyers clashing with a desperate class of short-selling banks fighting for their survival, you get volatility that breaks the system. You get moves that don't make sense, that violate every principle of technical analysis, that create opportunities and disasters in equal measure. Next week, the volume returns. The vacation ends. The senior traders come back to the room, open their terminals, and see charts that will make them question their sanity. And they will be forced to make a choice. Do they chase the price and fuel the fire, adding gasoline to an already raging inferno? Or do they try one last desperate attempt to smash the market, using every tool in their arsenal, deploying paper leverage to force the ratio back above 60 and restore the old order? If they chase, if they capitulate, and join the buying frenzy, we see triple digits in January. Silver at 100, 110, 120 becomes not just possible, but probable. If they attempt to smash it, to trigger stop losses and shake out weak hands, we could see a Widowmaker wick, a scenario where silver drops $10 in 10 minutes in a coordinated attack, only to recover it all an hour later, when the selling pressure exhausts itself and the real buyers step back in. This is the zone where over-leveraged retail traders get liquidated and destroyed right before the real move happens. This is where fortunes are lost by those who bet too big with borrowed money. You must be incredibly cautious. Do not gamble with leverage in a market this vertical. Do not put yourself in a position where a single violent shakeout can wipe out everything you've built. The path of least resistance is significantly higher. The ultimate destination is well above current levels, but the journey will be nauseating. It will test your conviction, your patience, and your ability to withstand psychological warfare. Gold paved the road months ago when it broke its own all-time highs and established the template for what happens when monetary metals break free from suppression. Now, silver is the slingshot, the little brother that was held back for years and is now making up for lost time. It is speeding down that road at 200 miles per hour, and the speedometer is still climbing. And we haven't even begun to discuss the physical reality underlying these paper price movements. While the paper price was detonating to $79 on the futures exchanges, something extraordinary was happening in the delivery mechanism. The holders of futures contracts were doing something the banks never expected, something that was supposed to be rare and exceptional. They were refusing to settle for cash. They were demanding delivery. They were saying, "I don't want your paper promises. I want the actual metal in my vault." We are witnessing a record-breaking run on the COMEX vaults in a month that is supposed to be quiet, a month when delivery is typically slow to a trickle because everyone is on holiday. The paper settlement mechanism, the very system that has allowed the banks to suppress the price for 40 years through fractional reserve alchemy, is failing in real time. The report I'm looking at, the official data that cannot be manipulated or hidden, shows a level of physical demand that constitutes a systemic rupture. This is not normal. This is not how the game is supposed to be played. The smart money is ignoring the noise, ignoring the talking heads on television, and watching the ratio with laser focus. The collapse to 57.3 is the signal that unlocks the vaults of the global elite. If a single pension fund, just one of the hundreds that exist globally, moves just 0.1% of its assets into silver, it creates a wave of pressure that the silver market physically cannot accommodate. It is an elephant trying to squeeze through a keyhole. The price must go vertical to create the liquidity necessary for these giants to enter. The market must rise to a level where holders of physical metal are willing to part with their positions, and that level is clearly far above where we are today. And if you think $79 is the ceiling, if you believe this is as high as it can go, look east. Look at the Shanghai Futures Exchange where the real physical market lives. The divergence between the east and the west is no longer a gap, it is a canyon. While New York is struggling to process $80 silver, while traders in Chicago are trying to understand what's happening, Shanghai is already trading at $85. That is a $5.50 premium on the physical metal, a spread that should not exist in a functioning, efficient global market. This proves beyond any doubt that the arbitrage is broken. In a functioning market, banks would buy at 79 in New York and sell at 85 in Shanghai to close the gap instantly, earning risk-free profit until the prices converged. The fact that this premium persists, that it continues day after day, tells you that the metal is stuck. It tells you that the Western vaults are empty, or that the banks are too terrified to ship the metal across the ocean because they need every ounce to cover their own massive short positions. They can't afford to let that silver leave their control because they've promised the same ounce to 10 different buyers. When the pension funds turn on their terminals next week and see the ratio at 57, they won't just look at the New York price. They will see the Shanghai price. They will see that they can buy paper contracts in the West at a massive discount to the real physical market in the East. It is the easiest trade on Wall Street, buying dollar bills for 90 cents. It is arbitrage so obvious that it screams from every screen, and institutional traders are paid enormous salaries specifically to identify and exploit these opportunities. And why are they rushing in now? Why is this happening at this precise moment? Because they are terrified. They see the Venezuela blockade threatening global supply chains. They see the repo market spikes signaling stress in the banking system. They see the inflation data that refuses to cooperate with the Fed's narrative. But most importantly, they see career risk. In the institutional world, you don't get fired for losing money on a bad trade. You get fired for missing a move this big. If silver is up nearly 200% and you have zero exposure, if you sat on the sidelines while the metal of the decade made history, your clients will take their money elsewhere. Your board will ask why you weren't positioned. Your job will be on the line. The buying we are about to see is driven by the most powerful force in human nature, self-preservation. This is not conviction buying. This is career preservation money, and it is price insensitive. These fund managers will pay whatever it takes to get their allocation because not having exposure is more dangerous than overpaying for the position. The banks are dying. The Federal Reserve's emergency $17 billion repo injection this morning was not a footnote buried in the economic calendar. It was a white flag waved by institutions that are drowning. It was the evidence of a systemic rupture that can no longer be hidden. When a bank has to deliver metal it doesn't have, when the paper promises come due, and the vault is empty, it has to buy that metal in the open market. To buy it, it needs cash, immediate liquidity. The silver market has become a black hole for capital, sucking liquidity out of the system at an unprecedented rate, draining the banks of the resources they need to survive. The Fed is trying to refill the pool, printing money and injecting it into the system, but they are caught in a doom loop from which there is no escape. By printing money to save the banks, they devalue the currency, which makes silver more expensive in dollar terms, which forces the banks to need even more money to cover their positions. It is a vicious cycle that accelerates with every intervention. The 12,176 delivery notices for December are the engine of this destruction. 64 million ounces of silver demanded in a single month. 8% of the planet is annual mining supply, during a holiday week when demand is supposed to be dormant. This is unprecedented. This is a run on the bank. These are not speculators looking to flip contracts for quick profit. They are industrial users who need the metal for manufacturing and strategic buyers who understand that the system is breaking. They are calling the bluff of the fractional reserve system. They are saying they don't trust the paper. They want the bars stacked in their vault where they can see them and touch them. The vaults are being emptied, bar by bar, and the fractional reserve game that has lasted for decades is finally over. We are moving into the unobtainium phase, the moment where the buy button disappears and the doors close, the moment where price becomes irrelevant because there is simply nothing left to buy. Wealth is not being destroyed in this process. It is being transferred from those who hold paper promises to those who hold atomic reality. Silver is element 47 on the periodic table. It cannot be printed by any central bank. It cannot be bailed out by any government, and it cannot be faked or counterfeited at scale. It is real, tangible, and finite. The $17 billion repo print was the pivot point, the moment when everything changed. The tightening cycle is dead. The Fed has chosen to sacrifice the dollar to save the banks, to protect the system at all costs, even if it means destroying the currency. By doing so, they have guaranteed triple-digit silver. Silver at $100 is no longer a forecast or a hopeful prediction. It is a mathematical certainty. It is the inevitable output of the equation the Fed just wrote with their emergency intervention. Next week, the volatility will be violent beyond anything you've experienced before. You will see moves that used to take a year happen in an hour. You will question your sanity and your conviction. You must have a stomach of steel and the discipline to hold through the chaos. But as long as that ratio is diving and Shanghai is leading and the vaults are emptying, the trend is your friend. The banks are out of metal and they are out of time. The ghost week is ending and reality is beginning. The $100 wave is not coming. It is already here, building offshore, gathering momentum. It is unstoppable, and you are the ones positioned to survive the greatest wealth transfer in human history. Hold the line. Do not trade your lifeboat for the sinking currency of a bankrupt empire. Do not let them shake you out with fear or seduce you with false promises of safety. The target is locked, the triggers are pulled, and the final move has begun. This is your moment. Do not waste it.